Hi folks, and welcome back to Meaningful Money. Okay, I'm still here at Trevian Cliff in the mist, but never mind. It's better than being stuck inside behind a desk. It's tax year end pretty imminently. This will be going out on Wednesday the 30th of March. Tax year ends on the 5th of April. 6th of April is the first day of the new tax year. So a couple of things for you to think about if you haven't already. To be honest, it's cutting it fine now, but never mind. 2 or 3 things for you to think about as the tax year end approaches. Remember, again, thanks to my good friends at 7 Investment Management, that Meaningful Money now comes sponsored by them. Thanks to them for their help. 3 things to think about at the tax year end. Firstly is pension contributions, right? If you haven't made a pension contribution this year, remember the amounts that you can put into pensions are based loosely on tax years. So you get so much that you can put into a pension in any given year. So those maximum are 3,600, or if higher, 100% of your salary. So you can put in the higher of £3,600 or 100% of your, it's actually salary is a dreadful word to use, it's relevant UK earnings, okay? So pensions, remember, are really valuable things to put money in, okay? Make sure you're getting the lowest cost one that you can, but with all the benefits that you want. But remember, pensions are the only place you can invest where you get given money to do so in the form of tax relief. I know there's plenty of arguments for and against pensions, and I certainly wouldn't use them exclusively for long-term saving, but they're really valuable things to have, and your time for this tax year, your window is running out. Remember also the annual allowance, which as it stands at the moment is £255,000. That's the maximum, the overall cap you can put in this year. So if you've got £250,000 burning a hole in your pocket, you could put it in a pension. As long as your salaries or your UK relevant earnings are up to that level. So I don't imagine there's too many people watching this where that's the case. That annual allowance, by the way, is changing next year. It's going down to 50,000. So pension contributions, get them in while you can. The second one is similar but related. It's your ISA allowance. Everybody gets an ISA allowance. ISAs are individual savings account. They are very tax efficient ways of saving and investing for the long term. They come in 2 forms, cash ISAs and stocks and shares ISAs. Now your overall allowance is £10,200, but of that, the most you can have in cash is £5,100. And if you do that, then the balance of the £5,100 has to go into a stocks and shares ISA. The alternative, though, is to have one stocks and shares ISA with up to £10,200 in it. And you get an allowance per person per tax year. So again, your time is running out to make the most of your ISA allowances, so get on with it if you haven't done it. Thirdly is to use your capital gains tax allowance if you haven't already. So let's say you've got some money invested and perhaps you've made some gains on it. What you invested in has gone up in value thanks to the stock market. Well, you might want to think about using your annual allowance. Everybody gets £10,100 per year that they can gain in any one tax year without paying any capital gains tax. Now, if this money is held within an ISA, you can forget capital gains tax. That's one of the benefits of ISAs. But if it's not, maybe you have some shares that you got from work or something like that, or maybe you inherited some Lloyd's TSB shares or whatever, and you've, by some amazing miracle, made a gain on those. Well, you might want to think about using that allowance. Okay, and the only way you can use that allowance is to realise that gain, which means sell some shares. So, and as ever, the golden rule is don't do something for tax benefits that it's not a good idea to do for other reasons. So, it may be that it's a particularly awful time to sell your Lloyd's TSB shares right now. Well, don't worry too much then about the tax implications. But if you're sitting on gains within a portfolio, think about whether it might benefit you to realise those gains and make use of that allowance. The flip side is also to realise losses, because you can carry losses forward for 5 years and 10 months, I think, from the end of the tax year in which those losses were gained. So let's say you're sitting on a loss and you think, this bunch of shares that I'm holding is pretty awful. I'm going to sell those and buy something else in the hope of making a gain. Well, the loss that you've made on those shares could be offset against any future gains, which could be pretty valuable for tax planning. So just think, talk to your accountant or your financial planner as to whether it's worth you making some, either realising some gains or losses as we get to the end of the tax year now. It's something that around this time I look after several trusts, and it's the sort of thing we're thinking about. We must use these allowances, they're there to be used, and if you don't use them, you'll lose them. And that's the same for all those three things: pension contributions, ISA contributions, or using your capital gains tax allowance. You've got to use them or you'll lose them because they're per tax year. Alright, so just three things to think about now at the end of the tax year. So that's it for this one. Next time I'm going to look about, I'm not going to look about at all, I'm going to look at how to handle a financial windfall. Thanks for watching, I'll see you next time.